As nations relied more heavily on debt, central banks rose to unprecedented power. They became the architects of global finance, controlling interest rates, liquidity, and stability. But they also became the quiet gatekeepers of a system that no longer rested on real assets, only on confidence and compounding obligations. After the Second World War, global leaders attempted to stabilize currencies through the Bretton Woods Agreement, linking money back to gold through the US dollar. But the system couldn't contain the expanding appetite for debt. Nations needed more money than gold reserves could support. By 1971, the pressure became unbearable. President Richard Nixon ended the dollar's convertibility to gold, severing the last tie between global currencies and tangible value. From that moment forward, money became purely symbolic, its worth determined by government decree and central bank policy. This shift unleashed a new era where money could be created without restraint. Central banks could expand their balance sheets infinitely, and governments could borrow without immediate consequence. The global economy began running on promises stacked upon promises, all supported by public trust. But every promise carries a cost. As debt creation accelerated, nations became trapped in a cycle where repaying old loans required taking new ones. Interest payments consumed budgets, public services strained, economic independence weakened. Countries discovered they were no longer free, they were bound by the system they created. This is the global debt prison, not built with walls or bars, but with compounding interest, unavoidable obligations, and financial structures reinforcing dependence. Nations that once controlled their fates now rely on central banks, bond markets, and foreign lenders to survive. While economies grew artificially from borrowed money, wealth inequality expanded. Those closest to the creation of money, governments, corporations, banks, benefited massively. Meanwhile, workers relying on wages saw their purchasing power decline as inflation chipped away at real value. The system rewarded proximity to the source. By the late 20th century, debt had become the foundation of political power. Campaigns were funded by financial elites. Governments shaped policies to protect markets. Central banks intervened constantly to prevent collapses caused by excessive borrowing. The line between public interest and financial necessity blurred. Then came the crises that revealed the fragility of this debt-based system. In 2008, a shockwave tore through global markets. Banks had pushed debt creation beyond sustainable limits. When they collapsed, central banks stepped in, creating trillions of new dollars to save the system. Debt wasn't reduced, it multiplied. This moment marked the final stage of the modern monetary transformation. Central banks became the lenders, buyers, and insurers of last resort. They purchased government bonds, corporate bonds, and even mortgages, expanding their balance sheets to historic levels. Money creation reached heights previously unimaginable, and while these actions prevented total collapse, they injected the world with unprecedented liquidity, inflating asset prices, distorting markets, and widening inequality